Nigeria's year-on-year inflation decelerated in August. Let's take a look at the numbers. There they are. August 17.01% from July 17.38. Food inflation 20.3%. July 21.03. Core inflation, yeah, we did see a deceleration there as well, 13.4% from July 13.72. Let's take a look at, I think, urban and rural inflation for year-on-year. Yes, so 17.59%, July for 18.01, and then rural inflation at 16.4 from 16.75. However, month-on-month inflation, interesting figures here. So you'll see here, August, it did actually increase month-on-month. August, 1.02% from July's levels. Also, food inflation month-on-month, 1.06 from July's levels at 0.86%. Core inflation, yeah, we did see a deceleration, though, in core inflation month-on-month. So both year-on-year and month-on-month for core, that did come down. Urban inflation, though, that did increase month-on-month. August, 1.06%, July, 0.98%, and rural inflation, 0.99 from 0.87%. So to talk us through these figures, Damilola Akinbami, who is the head of research at Financial Derivatives Company Limited, joins us. Damilola, good morning to you. Thanks for joining us.
Good morning, Rotus.
So, I mean, year-on-year decelerated, but numbers still, double digits still high. How do we chew on these numbers, Dami?
Yes, so first of all, like rightly said, the headline inflation declined to 17.01%. We were anticipating a steeper decline. We were projecting about 16.8%. But it came out slower than we expected. And all the indices, except for month-on-month, they all declined. So by that I mean food, core, urban and rural sub-indices declined. They moved in tandem with headline inflation. And the main reason for that decline in headline inflation can be attributed to base effect. Now, on the other hand, month-on-month inflation increased to about 1.02% when annualized as almost 13%, about 12.9%. And the major driver for this increase in month-on-month inflation is the currency pressure. And why the month-on-month is interesting or it's relevant is because it gives you a better picture. It's a more accurate reflection of market reality. Because if you go to the markets now, I mean, our viewers will be like, oh, but I'm still paying exorbitant prices to buy a bag of tomatoes or a tuber of new yam or something like that. And that's because, yes, we've seen some price declines for some commodities, and bear in mind that we're in the harvest season, but these declines are not significant enough to be noticed. And also, we've also seen that even price resistance, because that's also another factor that could consumer price resistance, because if you don't have the amount, that income, that could affect your demand, and obviously if demand falls, that would lead to a downward pressure on prices. That too is not, we're still seeing that have an impact, but the currency effect, the exchange rate volatility is what is at play right now. And if you look at the month under review, August, in August, the average power market rate was about 560 naira to a dollar. In July, it was 506 naira to a dollar. The I&E window rate was roughly around the same thing, 411 naira to a dollar. Now, why did I bring this up? It's because most manufacturers, most of them get just 10% of their forex needs from the IEFX window, meaning that the 90% is sourced elsewhere, predominantly the BDCs. And bear in mind the BDCs, at the July MPC meeting, the CBN stopped its forex sale to BDCs. So that market is experiencing an increase in demand, meanwhile supply is falling. And that's why we're seeing the power market rate moving towards 600. It's currently at 557 naira to a dollar. So because of that exchange rate impact on imported items, and you know that Nigeria imports practically almost everything, so increased import costs, increased raw materials, so that has fed into the cost of goods, and that's why we're seeing that play in right now. And Nigeria is not the only one going through what is experiencing, at least in terms of the overall headline inflation, because if you look at the global and regional trend, largely, we are seeing that deceleration occur. So U.S. numbers came out yesterday. The numbers declined to about 5.3% from 5.4%. China has fallen from 1% to about 0.8%. South Africa also recorded a decline. But we still have some outliers to this declining trend that we're seeing globally and regionally. UK's numbers came out this morning. And UK's inflation increased. Also, Ghana's inflation too has been steadily increasing. It's almost at 10%. But what we're seeing generally is that there's that global decline in inflation, but price pressures still remain. So then that's just a nutshell of the inflation numbers.
I mean, excellent stuff. Thank you for the breakdown. So going forward, do you expect the trend to continue?
Well, going forward, so right now, the average year-to-date for the first 8 months of the year, inflation is about 17.52% thereabout, and some analysts are projecting about 17.2%. And no, because we're in the harvest season, so that definitely is still going to play an impact on consumer prices. So not all things being equal, we should continue to see that deceleration in prices. However, the inflation risks are still elevated, and there are 4 major factors. One, money supply growth is still there. I talked about the exchange rate volatility, definitely with power market rate at 557, and the fact that a lot of manufacturers are getting their dollars from the BDCs, so they are using a blended rate. Right now, the blended rate is about 540, and if the power market rate continues to move, it could even increase further. So definitely that will continue to feed on imported items. We also have energy costs. We know that there's that likelihood. It's not a matter of if, it's now a matter of when the fuel subsidies will be removed. Definitely, that will impact on transport fares and inflation. We know that even electricity tariffs, there talks about the hike in that. Cooking gas has increased. I know how much I bought it in July and how much it is right now. So we still have some of these factors that would keep inflationary pressures elevated. But what could mitigate the impact of these, consumer price resistance to the price increase and the harvest season? And bear in mind that as you move closer to December, we're going to be entering the Christmas season. Yes. I know that seasonal demand, obviously, it's not going to be as high as previous years because of COVID impact on consumer disposable incomes. But definitely, during November, December, and the festivity period, the amount of rice you would consume definitely will be more than, so that increased demand definitely would put pressure on prices. So I think down the line, we're going to see, if at all, inflation decline, but marginally. But if this exchange rate pressure continues, that could lead to a reversal in the downward trend.
Thank you for that. What about investments? Huh? Yes. What do investors do? See, I don't put those numbers up again. No, money market isn't doing 17%. Stock market isn't doing 17%.
No.
So what's that? Look at that. What's that investor to do?
Well, the good thing is that, okay, fine, inflation is declining. So that means that, like rightly said, all our equity return or stock market return, even look at fixed income return, are not as high as 17%.
Right.
But so we're still experiencing negative real returns. But the fact that inflation is declining, so that negative real return is narrowing.
Right.
And bear in mind that last week, the Treasury bill auction results, we saw a reversal in the downward trend of the 364-day Treasury bill. So it moved from 6.8% to 7.2%. So for investors, the good news there is that at least the rate of return, the negative rate of return is narrowing. Yes.
The MPC meeting, I understand it's been rescheduled to tomorrow and Friday. So do you think the Monetary Policy Committee will react to these figures or stay the course? What do you think?
Oh, well, I think they're going to stay the course. So I'm going to give that a probability of them maintaining status quo about 60%. And why I'm saying that is because the inflation numbers, like I started, when I said earlier that we were projecting a steeper fall to 16.8%. But since it's still above 17%, that might make them consider maintaining status quo. We know that GDP numbers came in stronger than expected, but that is historical. Q3 numbers from our projections and what we are seeing, we expect that Q3 growth numbers, GDP growth numbers, would actually come out slower while projecting about 3% thereabout. Because, it was base effect that affected or influenced Q2 numbers. So we feel that we're going to see that slow down in Q3 numbers. So I feel that because of this and because of the exchange rate impact, the currency pressures, I feel that the MPC is going to maintain status quo for now. And when September numbers come out, if that decline continues and is even steeper, then they still have 1 more month, which is in November, to consider adopting a different policy stance. But if you even look at what is happening in Africa, a lot of African countries have stayed the course. They've left their interest rates unchanged, and that could happen in Nigeria, at least for the rest of the year.
Damilola Akinbami, Head of Research, Financial Derivatives Company Limited. Thank you so much for joining us.
Thank you, Otis.